Welcome back to the Financial Freedom Show. My name is Rob Berger, and in today's episode, we're talking all things balance sheets, net worth statements, what they are, how they affect us, why we should track them, how we should track them. We're going to look not only at personal net worth statements, which is the focus of this video, but we're also going to look at some corporate financial statements. Apple, we're going to talk about Tesla, because the way our own balance sheet works, and particularly in relation to our monthly or annual budget, is frankly very similar to how these same financial statements work for the largest companies in the world. Now, before we get started, I am wearing my Marine cap. A big thank you to all of the men and women that keep us safe every single day, not only in our military, armed services, but first responders. I'm also wearing it so you don't have to, look at that. All right. Back on with the cap. All right, let's get started. And I'm gonna make a bold statement to begin with, and that is that your net worth statement, my net worth statement, is the single most important financial document that we should track, and it is our North Star. We have countless financial goals. You may want to get out of debt, save for a child's education, pay off student loans, buy a house, buy a car, increase your emergency fund, save for retirement. There's a lot, right? But at the end of the day, we can use our net worth statement to track our ultimate, hopefully, progress moving forward and building our net worth. Going to dive into why that is in more detail as we work through this video. Of course, I'm going to give you some examples of some spreadsheets you can use, tools you can use. So let's get started. The first thing is just what is it? What is a net worth statement or balance sheet? And it's simply a reflection of everything that we own and everything that we owe. So it's all of our assets. You can imagine that at the top of the balance sheet. And then below that, all of our debts or liabilities. And our net worth is simply the difference. Hopefully we have more assets than liabilities, in which case we have a net worth. But some of us, that might not be the case. That certainly wasn't the case for my wife and I. When I graduated from law school in 1992, the only asset we owned was a car. It had actually been stolen when I was in law school in Boston, and I guess I would say vandalized. It was pretty gross. Anyway, our insurance company was kind enough to paste it back together, and we hobbled back to Washington, D.C. when I graduated, and that was our asset. It was probably worth, $1,000 maybe. And we had school loans of about $55,000. And that was back in 1992. Today's dollars, I don't know, 150 grand, maybe more. Yeah, it was a lot. So we had a big negative net worth. In any event, that is a balance sheet, right? Assets minus liabilities. And the result is hopefully a net worth. Pretty straightforward. Now, we're going to look in a minute as to exactly what kinds of assets we might want to include in the balance sheet and what kinds of liabilities. Straightforward as well. But that's a net worth statement. That's a balance sheet. Now, one question we want to look at is, what's the difference between a balance sheet on the one hand and our income statement? A corporation would call it. We might just call it our budget. What's the difference between those two things? Well, of course, at one level, it's obvious, right? A budget simply shows how much we make. You can imagine that at the top. And then below that are all of our expenses for the month, or we could look at a budget on an annual basis. And that's, of course, very different than what we own and what we owe. But when we dig a little deeper, we can see some sort of fundamental differences. The first is a budget covers a period of time, right? So we think of our monthly budget. We think of a yearly budget. But it's over a period of time, whereas a balance sheet is a snapshot. It's what's our budget on 12/31, the end of the year, or what's our budget on this specific day. You could think of our net worth. You could think of a budget as almost like a video over a period of time, and a net worth is like a snapshot. It's like a picture, right? And that's true for you and I. It's also true for the largest companies in the world. In fact, let's take a quick look. What you see on the screen, I'm going to actually walk through how I found this so that you can do the same thing. But I wanted to look at Apple's financial statements just to show you how their balance sheet net worth, while the numbers are a lot larger than ours, fundamentally they're the same thing. So I just searched for Apple 10K. 10K is the name of the form that corporations file, publicly traded companies file with the SEC once a year. It's their annual report and it includes their financial statements. They also file a quarterly report, which also includes financial statements. That's called a 10Q, Q for quarterly. But I wanted to look at their annuals, so I just Googled Apple 10K. You can find this information in a lot of places, but I like to go, in this case, directly to Apple. This is Apple's website for their investor relations. And we can come down here and we can search for all of their SEC filings. I specifically want to look at annual. And so it brings up, as you can see, all their 10Ks. And we'll just look at the most recent, and we'll look at the PDF version. So here is their 10K. Let me make it a little larger. Now, what's in this 10K is highly regulated by the SEC. I'll give you an example. Look at item 4, mine safety disclosures. You might wonder, why exactly does Apple have mine? They don't mine anything, do they? Well, if we go to it, not applicable. So yeah, no, they're not in the mining business, but it's included because the SEC says it has to be included. So what you see here is highly regulated. And one thing that you'll always know is that item 8 on a 10K, and you can see it right here, will be a company's financial statements. So we can click there and we can start to look at their financial statements. And the first one we see is consolidated statements of operations, which is just a fancy way of saying their income statement. This is their budget, if you will. Again, the number's slightly larger than my budget, probably a little larger than yours as well. But the thing I want to point out is you see here it says years ended. So this is not their income statement for, say, September 26, 2020. It's their income statement for the year ended September 26, 2020. And if you're wondering why September 26 in 2020 and then September 28 in 2019 and September 29 in 2018, that's because Apple's year end is a bit funky. Most companies, I think, have a calendar year end, 12/31, but obviously they don't have to have that as their year end. And in this case, Apple's an example of a company that uses a slightly different formula for calculating their year end. But the point is, their income statement covers a period of time. For the 10K, it covers an annual period, and you can see here they showed you 3 years in a row. If we go down to their balance sheet, and it's a few statements below here, here we go, their consolidated balance sheet, you'll notice it no longer says, year ended, right? If we go back up here, we've got years ended, right? We go down to the balance sheet, it's not there. That's because this is Apple's balance sheet as of a specific day, September 26th. If they did a balance sheet as of September 25, it would have looked different. Now, it probably wouldn't have looked significantly different, but the numbers would have been different, and it would be different if they used September 27th. The point is, the time period covered by a balance sheet and an income statement are different because they function in a different way. An income statement, or in our case, a budget, is over a period of time. I think usually monthly for most of us. I look at it monthly and annually. And our balance sheet or net worth statement is for a period of time. I tend to look at mine in 2 ways on a daily basis. I'll explain that when we get to the tools, but primarily on an annual basis. All right. That's the first difference between a net worth statement and so your budget. The second difference, though, and this is, I think, even more important, is what actually affects these. What transactions affect our budget? What transactions affect our net worth? And here's the key thing to remember. Every single thing we do with money, every transaction we engage in, whether we're buying tickets to go to the movies, if we do that anymore, or we're paying down our credit card or whatever, every single transaction affects our net worth. Every single one. And I'll give you some examples in a minute. On the other hand, not every single thing we do actually affects our budget. So I like to look at these financial statements as sort of 4 boxes. Our assets go here, our liabilities are down here, and we've got income and expenses. And I'm sorry my handwriting's so bad. That's from 25 years of practicing law and writing too much. And okay, so we can sort of model every single transaction that we would engage in financially in just 4 boxes. And I think it can be very helpful to understand it this way. So let's imagine we get paid, it's payday, and we'll ignore taxes and other things just to keep it simple. But we'll assume we make $2,500, and that would go in income. If we were doing double entry accounting with debits and credits, this would be a credit. Right? Credit increases income. Now, where does that money go? Well, let's say it's a direct deposit into our checking account. So we would have a cash account here, right? And we would increase it by the $2,500. This would, again, we're offsetting debits and credits. It would be a debit. And so if we think about this simple transaction that, if we're working, happens every couple of weeks, we've just, what have we done? We've just increased our net worth by $2,500. Now, if you're like me, it doesn't stay that way for long because we're going to start spending this money. But this is an example, simple transaction that affects both our budget. We've got our budget over here, right? Or income statement, if you will. And we've got our balance sheet. Whoops. Our balance sheet over here. It affects both of them. But not every transaction affects our budget. And let me give you an example. Let's imagine that a week ago we bought an Xbox Series X console, which, by the way, I've tried to buy and I can't find one. But in any event, and so we have this credit card balance of $500, and we decide we're going to just pay it off. We haven't been charging the interest. We want to pay it off right away. So how would that transaction, what would that look like? Well, we would decrease our cash, right, by $500. Right, so this would actually be a credit because we're lowering an asset by $500. And we have a credit card bill here, a credit card debt that was $500, right? And we're going to pay that off. So this is going to go from $500, we'll just do it this way. It's going to go from $500 balance down to a $0 balance, right? And that would be a debit because we're lowering our liability. Now, this is a perfect example of a transaction that had absolutely no impact on our budget, right? Now, $500 went out of our checking account, so we might think of it in terms of a budget, an influence on our budget, but it actually isn't an expense. We just transferred money from one account, a checking account, to another account, a credit card, right? And our net worth didn't change at all, right? Our assets went down by $500, that's true, but our liabilities also went down by $500. And so the net effect on our net worth was no change at all. Now, you might be saying, well, that's great, Rob, but I mean, we had this $500 charge. It came from somewhere, right? We spent something, we bought something. Well, that's right. And when we bought it, that's when we would have seen the expense show up. So if we go back in time a week ago, and when we bought the Xbox, what would that look like? Well, we'd have a $500 expense. I guess we might call it, I don't know, entertainment. I'm not sure what you'd call it, but it was $500, right? And we increased, for this transaction, we increased our liabilities by $500, right? A credit card. So that's what it looked like when we spent the money and charged it on our credit card. Now, for this particular transaction, our net worth did go down, right? Because we increased our liabilities by $500. So that would have reduced our net worth, assets minus liabilities, by $500. And this distinction actually is helpful when you think about using budgeting software. And here's why. If you're using something like Personal Capital, which is what we use, or maybe use Quicken, or it doesn't matter what you use, when you spend this money and charge it, spend it here and charge it to your credit card, that's when budgeting software shows it as an expense. And again, you're going to categorize it however you want to, entertainment or whatever, but it's going to show up in the budgeting tool when you charge the card. When you actually pay it off, it's simply going to show up as a transfer. It's not going to, when you pay it off, it's not going to affect your expenses at all. That they've already been affected. When you pay it off, it's simply going to show it as a transfer from one account, in this case your checking account, let's say, to your credit card. And so, for example, in Personal Capital, which categorizes transactions automatically, when it shows a payment I've made to one of our credit cards, it doesn't actually attribute that at all to an expense category. It shows it as a transfer, and that's exactly how it should be. All right, now what should we include in our net worth? And here, I think it's I have two rules, basically, and I think they could apply to just about every situation. Rule number one is you include every single liability that you have, every single debt. Doesn't matter if it's a credit card, student loans, a mortgage, a personal loan you owe to a friend. Every liability gets included in your net worth statement. That's rule number one. With assets, I have a separate rule, and that is you include cash and every asset that over time you expect to go up in value. That's rule number two. And that rule means you're going to exclude some things that may be surprising to some folks. So, for example, I do not include our cars in our net worth statement. Yes, they have value. Yes, if we were doing a complete net worth statement, we would include the cars. But I don't include them because over time they depreciate, and then they're worth very little if you keep cars as long as we do, and you get rid of them and you have to go out and spend more money to buy another car. So I, of course, include all our investments, both in retirement accounts and taxable accounts. I include our HSA accounts, all of our bank accounts, but I don't include assets that depreciate over time. Now, you may be a car collector, and maybe you've got old cars that go up in value. If I had those, I don't, but if I did, I would include those. But for the car we drive to the grocery store and back every day, I don't include that. Of course, you can if you want to, but you'll need to remember to decrease its value every year as it depreciates. I just prefer to leave it off. And when I was keeping them on there years ago, it's almost sort of boosted my net worth, which may have made me feel better. But the day was coming when that car wasn't worth much. So that's my approach. I include every single liability. I think that's sort of non-negotiable. There's no reason to leave off a liability from your net worth statement. But on the balance on the asset side, I only include cash and assets that over time go up in value. That, of course, would include our home as well. Now, let's talk about Tesla just briefly as an example. I said I don't include assets that go down in value, but of course, publicly traded companies have to include all of their assets, including those assets that go down in value. And I want to explain this because it's really important, particularly if you're trying to analyze balance sheets, income statements for publicly traded companies, to perhaps invest in individual stocks. So let me just use Tesla as an example. Let's imagine that they're building, which I think they are, or have, a manufacturing facility in India, right? And let's imagine it's going to cost, I don't know, $1 billion. Well, does that money, how does it affect their financial statements? Does it get is it all expensed? Will they show $1 billion in expenses in the year they build this thing, and that in turn reduces their net income? Or does some of it, as we've seen in simple transactions, does some of the money that they spend only affect the balance sheet, at least initially? It depends entirely on how they're spending the money. For example, they may hire an individual to manage this project in India. Let's imagine they pay them $250,000 a year. That money is going to get expensed, right? They're spending money for someone's services for a year. And once the year's up, they've spent the money, they've gotten their services, there's nothing left. If they want that person to continue on for another year, well, they got to pay him again, right? So that money is going to get expensed. But now let's imagine they spend $100 million in manufacturing equipment for this facility. Well, that's a long-lived asset. They're not going to just use it for a year and then throw it away. At least I hope not, right? They may use it for 5 or 10 years or even longer. And so under GAAP accounting rules, they're going to have to, they call it capitalizing it. They're going to put it on their balance sheet. So, for example, they might spend $100 million in cash. That lowers their assets, their cash assets. But they're then going to put this machinery on their balance sheet. So now they're going to have $100 million in machinery on their balance sheet. So the actual effect of their net worth just from that transaction alone, there's no effect at all. And it doesn't show up on their income statement, at least not yet. But what's going to happen is they're going to depreciate the value of that equipment over time. And the rules for this in the United States are in part based on GAAP rules and in part based on income tax rules, which can be different. But let's imagine they're going to depreciate it over a 10-year period. So during year one, what they'll do is they'll actually record a $10 million depreciation expense. That's what will hit their income statement. That's what will, in that first year, lower their Tesla's net income by, in our hypothetical, $10 million. And the other side of that transaction will appear on their balance sheet. They will lower the value, the reported value of the machinery from $100 million, and they'll subtract that $10 million they depreciated, and now it will be reflected on their balance sheet at $90 million. And then in year two, they'll do the same thing over again, right? So that's how, at a high level, and a pretty, I guess, simple example, the purchase of something like machinery would affect the financial statements of a publicly traded company. Now, there are lots of implications of that for investors, perhaps for a future video, but I wanted to sort of show you that as individuals, I don't capitalize anything. Now, again, that's why I don't put my cars, for example, on our balance sheet. But if you did, you're effectively doing the same thing Tesla does. And just like Tesla, if you want to keep your financial statements accurate, you would want to depreciate the value of that capitalized asset, in our case, a car, each year as it goes down in value. All right, so how do we actually keep track of our net worth? I use two methods, and they're both free. The first is I use a Google Sheet. Now, what I'm showing you on the screen is from Money Under 30. It's founded by a good friend of mine, and he sold his site to the same company I sold mine to. But in any event, this is a free net worth spreadsheet. This is actually using Excel. If you were to download this, it would look like this. And then, of course, you can edit this as you'd like to. I would probably move it over to Google Sheet. But however you do it, this is your basic net worth tracker. Now, this shows it by month, as you can see here. I tend to not do mine in a spreadsheet by month. I do it by year. So each column, in my case, would be a year, 2020, 2021, and so on. Of course, how you do it, totally up to you. But you can see it's pretty basic. You got your assets and your liabilities, and then they just do the math down here as a formula to calculate your net worth, and they also calculate the change. You could obviously customize the different assets and liabilities to meet your specific financial situation, but very easy to do. As I said, I update ours once a year, just updated it at the end of 2020. And the thing I like about this, particularly if you, instead of doing it by month, you do it by year, is it shows you hopefully some progress every year. And I think that is incredibly important for reasons I'll mention in just a minute. But this is the first way to track your net worth. Obviously very easy to do and doesn't cost anything. The other thing I do is use Personal Capital. This is just a screenshot of a demo that Personal Capital puts out, but this is their dashboard. This is where you can kind of see all of your financial information in one place. You can see at the top, it calculates your net worth, including your assets and your liabilities. In this demo, the person's net worth is $816,754. And you can click into the net worth and actually see all of the detail. The thing I like about this is when you connect all of your investment accounts and bank accounts and all your loans, you can connect mortgages, credit cards, and so on. It updates your net worth automatically, and it shows your net worth over time. As the stock market goes up or down, it factors that in automatically. As you make contributions, let's say to a 401k or to an emergency fund or whatever, it brings that data in, calculates it automatically. So I use both methods. I use both a spreadsheet that I update once a year, and I use Personal Capital that gets updated, I like to say automatically for me on a daily basis. Not the only two ways, of course, to track your net worth. Heck, you could use paper and pencil if you want to. But these are the two I use. I've used them for years, and they've worked very well. And as I said, they're both free. Now I'd like to show you one more example of how a very important transaction flows through your balance sheet and budget. And then I'm going to conclude the video by explaining why I think your net worth should be your ultimate financial goal. All right, the example I want to show you is a dividend. Now, if you're like me, particularly in retirement accounts, you automatically reinvest your dividend. So they come in, you might not even notice it. They just come in and get reinvested. But if we were going to actually model the payment of a dividend through our financial statements, what would that look like? Well, when the dividend is paid, it actually becomes income, right? We get, let's say we get a $500 dividend check, right? That's income to us, right? That would be a credit. And it would also, though, be an asset, right? It would probably be in our brokerage account. Let's assume for the moment we don't automatically reinvest it. It might be in a retirement account, let's say, maybe a 401k, and we would have $500, and that would be a debit, right? Let me try that again. There we go. So that's what it would look like when it first comes in. Now, what happens next is really important. What do we do with that dividend? Now, if you can imagine someone is, let's say, retired, they might spend it, right? They may go to the grocery store and spend $500. So what would that look like? Well, of course, they'd have a $500 expense, and that would be a debit. And then their 401k, let's just imagine they pulled it from their 401k in retirement. So that would be a $500 credit, and it would reduce their balance. This increases their balance. This would reduce their balance. And that's what it would look like. It came in as income, which increased their 401k. It went out as an expense for maybe groceries or whatever they purchased with it. And it decreased their 401k balance. Now, if you're not in retirement and maybe you reinvest your dividends and perhaps you do it automatically, well, it would still be income, right? And it would increase your 401k and it would just stay there. Now, inside your 401k, it would be cash first, technically, in your brokerage account, and then it would go right into, let's say, an S&P 500 index fund or whatever you're investing in. But the point is, it would stay here in your balance sheet. It wouldn't actually be spent and hit the expenses on your income statement. And this sort of underscores an important part of the balance sheet and something that I like to think about when I'm analyzing our own net worth statement. And that is, I like to look at all of our assets that are generating income or generating some sort of profit. It could be in the form of a dividend, right, as we just looked at, but it could also simply be an increase. Oops, let me try that again. Boy, I can't do an arrow. An increase in value, right, because the market goes up. And I like to think about the assets that we have on our balance sheet and what I think over the long term their increase in value will be. Now, we all know with the stock market, it can go down quickly, very shortly, and we can have bad years and good years. But I like to think about my overall portfolio. Right now, we're about 80% stocks, 20% bonds. I know long term, that generally, including dividends, returns around 9%. I could even assume a lower return if I think maybe I'm not so optimistic about the future. But whatever return assumption I want to make, I like to think about all of these investments and assets on our balance sheet as actually producing income, because that's exactly what they do. And when you're starting out, all of your income comes from what? From work, right? You have very little saved, at least if you're like we were, very little saved. If I want to improve my net worth, it's all coming from over here, income from a job. But what happens over time with compounding, if you're saving money and investing it, is that actually the income comes from your balance sheet in the form of, again, dividends, interest, or perhaps increases in value. Technically, you could see it flowing into your income statement, and then if you reinvest it, going right back into your balance sheet. That is where real wealth is built. And what you'll find over time is that your wealth, most of it will come from this process right here. It won't come from just your work. That's what gets that's what gets it started. But this is what generates long-term wealth. But it can only happen if you spend less than you make and you invest the rest wisely. Well, if you've made it this far, first, thank you. You're a real trooper. I know that I love this stuff, and maybe I'm just odd that way. But the reality is, the net worth statement can seem kind of boring at one level, but if you dig into how it actually functions, both for you and I and for corporations, man, it's where it matters. That's where it's at, is your net worth statement. And I think tracking your net worth is important in part because it really should be your ultimate goal. You may want to get out of debt. That's terrific, an important goal. You may want to buy a home. You may want to max out your 401k. You may want to save for a child's education. So you may have all of these sort of sub-goals. But keep your net worth and improving your net worth as your ultimate goal. I think it's your ultimate progress. It may feel good to pay off a credit card, and that it does feel good. Whether that was a smart decision, though, depends on a lot of factors, including what the interest rate was on that credit card. Could you have invested that in your 401k and gotten an employer match? We want to think beyond the individual goals that we have, as important as they are, and always keep an eye on our overall net worth and its progress. I think that really is the ultimate goal. And one good thing to do over time is to look back and at your net worth in prior years to see your progress. You may have goals in the future, and they're important to focus on as well. But frankly, if that's all you focus on, it can be a little discouraging if you're not moving as fast as you'd like to. But when you look back and you look at where you've come from and you see positive progress, I think this is true with anything. Everything from losing weight to building wealth. If we can look back and see progress, I think it can be very encouraging and very, very motivating. Well, that's my take on net worth, why I think it's the most important, how to track it, why to track it. If you have any questions, leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.